Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money. And here with me today, Yahoo Finance's markets reporter Josh Schaefer and Yahoo Finance contributor Hope King, both on set. We've got 1 hour to go until the market close. We're going to take a quick look at the major indices here. We know what the big topics are today. Listen, it's trade and it's tariffs. They are back in focus. President Trump going after China on social media, talking tough. We have a new report from Bloomberg that the U.S. plans to broaden restrictions on China's tech sector. So if you add it up and you look at our major indices right now, you got the Dow basically flat, up 32 points. S&P 500, your broad gauge down about 0.2%, and your tech-heavy NASDAQ down about 0.6%. But Joshua, we have some red on the screen, but let's not take away from the solid month we have had in stocks. And our very own colleague Jared Blickery tells me this stat, which is interesting. S&P 500 and the NASDAQ on track here for their best months since November 2023. What do you make of that?
Yeah, Josh, best month since November 2023. I think a lot of that has to do, of course, with the unwind of a lot of the tariffs we've been hearing about, right? A lot of Trump rollbacks if we think about what the month of May was. And then interesting, you pointed out, Jared points out best month since 2023. Our Jared Blickery also ran some more numbers, Josh, looking at perhaps the best May since 1997 for the S&P 500. And then he took a look at what happens when we have a strong May. Normally you hear that sell in May, go away, right? But if you have a strong May, the S&P 500 goes up in May more than 3%, then you actually see a median return of almost 11% through the end of the year and a median return of 15% over the next 12 months. So normally when you see this strong of a May, it usually comes a mid-able market and a midi rising market, which I don't think either of us would have thought we'd be talking about that going back a month and a half ago.
For sure. Hope King, bring you here as well. It was not just a solid May, but as Josh pointed out, this powerful rebound from the April lows. What do you make of it, Hope? What are the big trends and themes for you that you're watching?
I mean, this pattern recognition by retail investors buying the dip. And if you look at how much they've actually earned, you actually had public CEO, investing at public, looking at data between April 3rd and May 9th, they earned a nearly 12% return in buying that dip. And retail investors, even though they're not back in the markets the way they were during the pandemic, they're still making up volume-wise about 20% of U.S. equity trading volume, which is significant.
Wow. Here's a question, Josh, I want to bounce off you as well as a guy who speaks to a lot of smart strategists. When you talk about that big rebound from early April, and you mentioned, we talk a lot about the trade truce, the trade reprieve, whatever you want to call it. How much of it is that, and how much of it is what we've also discussed a lot, which is that earnings, solid, at least the hard economic data, resilient. How do you try to weigh all those as explainers?
Yeah, I was throwing this to a couple strategists this week, Josh, right? And Drew Pettit over at Citi said to me, he goes, I think the headlines were tariffs.
Yeah.
We probably didn't talk enough about earnings, right? The S&P 500 in aggregate with 98% of the index down at this point grew earnings 13% year over year, right? Big tech, Mag 7 grew earnings over 27%, right? When you look at those numbers, it's like, oh, wow, they're actually doing very well. And then you think even forward looking, right? Of course, that's usually where the market's at. 3% of companies, I think, in the S&P 500 pull guidance, nothing close to what we saw in 2020. So the uncertainty aspect moving forward feels a little bit removed.
Yep. All right, we're switching gears here. As we mentioned, another big story today, President Trump saying China violated its trade deal with the U.S. And this comes as the Trump administration reportedly plans to widen restrictions on China's tech sector. According to Bloomberg, Yahoo Finance's Jennifer Schonberger joins us now with the latest. Jen.
Josh, just moments ago in the Oval Office, President Trump reiterating that China violated part of an agreement with the United States, but that he hopes to speak with Chinese President Xi and that, quote, hopefully we will work something out. Of course, this coming after the president tweeted something very similar overnight and after Treasury Secretary Scott Bessent said late Thursday that talks with China have, quote, stalled a bit. We got a little bit of color earlier today from U.S. Trade Representative Jamieson Greer, who said that China has been reluctant to export those critical minerals and has been slow walking on export licensees. Of course, all of this coming after the appeals court granted a reprieve for the president and the White House on the tariffs. The U.S. International Court had ruled late Wednesday evening that those tariffs were illegal under the International Emergency Economic Powers Act. The president praising the stay, approval of that stay from the appeals court today in the Oval, saying that without tariffs and the power and leaving tariffs unchanged, unchecked, we wouldn't have a country or an economy. Take a listen.
We have a lot of countries that use tariffs on us and use them viciously, actually, viciously. And if we didn't have the power to use tariffs on them and instantly, not when you go back to Congress and try and get hundreds of people to agree on something, that would take months to get just one simple proclamation.
All of this coming during a 50-minute press conference in the Oval Office that ended just moments ago, where Elon Musk was alongside President Trump, that event being billed as sort of a farewell to Elon Musk as he leaves the government, though it was made clear that while Musk is officially leaving, he is still going to serve in an informal capacity as an advisor to the president. Musk telling reporters that Doge is just getting started and that he fully expects $1 trillion in savings by the middle of next year. The president himself saying that he expects Musk to come and go, that this is his baby, referring to Doge. And for those who were wondering why there was a bruise on the side of Musk's eye, well, apparently he got punched in the face by his 5-year-old. Guys.
Yeah, that was a bruiser, Jen, for sure.
Hey, touche.
It is interesting, Jen, how, as you pointed out, and I wanted to ask you about this, it does feel like, as you're reading the headlines, the temperature being raised, and it feels a little bit like all of a sudden, Jen, like across the board. It's not, as you point out, it wasn't just the president this morning. He goes on social media and he's talking tough. And then you have the Bloomberg report. And then, as you noted, on top of that, you got Besant telling Fox News in an interview, publicly saying he's unhappy, he's frustrated, everything. I think he used the word stalled, referring to those talks. What do you make of the kind of coordination of it? Am I reading too much into it? And what do you think comes next?
Josh, you know, it's always tough to sort of read the tea leaves on this without actually knowing what's going on behind closed doors. But it clearly appears that they're hitting a wall with China at this point. I don't think that the Treasury Secretary would have said that the talks have stalled a bit. And so the president, knowing how he uses his playbook, is probably going back in and trying to reassert pressure on the world's second largest economy to bring them back to the negotiating table in the way that the U.S. wants and the president sees fit. Of course, just my 2 cents here, looking at, as you said, how the pressure has been dialed back up here over the past week or so. And it's not just been China, right? It's been Europe as well as we approach that 90-day mark in July. So just about a little over a month to go here, though those negotiations still ongoing despite the legal whiplash that we've seen this week as well. And we're just going to have to see how this plays out.
Jen, thanks so much. Appreciate it. Well, Elon Musk's time in the U.S. government is coming to an end, but he might not be completely out for good.
Well, I expect to continue to provide advice whenever the president would like advice.
I hope so.
I expect to remain a friend and an advisor, and certainly if there's anything the president wants me to do, I'm at the president's service.
Well, for more on Musk's next chapter, let's get to Yahoo Finance's Praz Subramanian. Praz, you were listening. What did you make of that presser? What were the takeaways?
We got to rewind. I mean, the big bombshell today was the report of alleged drug use by the New York Times, more than what had been originally thought. Ketamine, mushrooms, so much ketamine that he potentially had a bladder injury. These were all reports that came out today, this morning, in the New York Times. Musk was asked about it, and he said, quote, that New York Times, referring to the New York Times that had put out a report on the Russian hoax stuff, all that stuff, he said, I'm going to move on. Let's move on. He didn't address it.
Didn't want to
didn't address it. And Jen brought the fact that he also had a peculiar eye injury.
See, that's why I thought you were going to lead with the Shiner.
Yeah. Well, Jen stole my thunder.
That's where,
That was the story.
Thunder was stolen. Thunder was stolen. So I'm bringing that back.
And pinned that on X, I think, his kid.
Yeah, said that his son, presumably a lefty, a right Shiner. But all very interesting stuff here. Yeah. Musk, yes, he did say that he's coming back to Tesla and SpaceX and X full-time. But of course, today's report on that alleged drug use, the Shiner on his face in the Oval Office, plus the sort of non-answer or non-denial of it all, really kind of is concerning. I mean, if you're a Tesla investor, Tesla analyst, a fan of the company, et cetera, you're kind of wondering what's going on here with Elon. Is he really sort of having some issues here, potentially, given the fact that he looked like he had an injury?
Do you think, Praz, that now that he's going back to work full time, right, and this is sort of the exit, do you think when he was with Trump, it was a very outspoken, hard-hitting Elon Musk, very political, no prisoners? And I don't know how many analysts we have talked to on the show saying, well, in their opinion, could that have done some brand damage? Maybe it won over some Republicans, but maybe it turned off some Democrats. I just wondered, do you think now that he's rotating out of government, right, he goes back to work, would you expect him to dial all that back down?
I think he's already doing that. Over the last few weeks, that when he sort of hinted at his return to his businesses, he did say that, or he did sort of tweet less about the political stuff, the social stuff, talking more about SpaceX, X.com, more about Tesla's sort of technology. Tweeted about the Model X yesterday. So we're seeing more about his return to his businesses. I think everyone would like to see that who is an investor in his companies. And I think that's already happening. But with Musk, you never know. He loves the drama, apparently, and he can always kind of come back into that.
Praz, I just think you read through that New York Times article and you look at everything that's happening, and the theory, the rally in the stock realistically over the last month has been Musk is coming back, right? That's the key catalyst we've been talking about, And I'm just sitting here wondering, I get Elon the visionary, I totally get it. Doesn't it still feel like he has his mind in 7 different places? And we're still having the conversation like when he bought Twitter, where it's like, which one is he working at? He runs so many businesses that it's like, what is he literally doing at Tesla on a daily basis that is going to help the company tomorrow? And for me, I just feel like it's hard to picture at this point.
You know, he's always been the kind of guy that's had a lot of sort of hats to wear, right? He makes a joke about that, but he's been able to sort of, partition his time with SpaceX and with Boring Company and with Tesla, and still been highly functional. I think that there was concerns about him buying X, right, back in the back then, Twitter. Now you're seeing it to the point that if he just peels back from the political stuff, we'll accept his hats in different arenas with his companies. I think that's okay. I think the second big factor is the fact that the stock is up because of the fact that Austin's robotaxi testing begins next month, potentially as early as June 12th. He said they're actually already doing these limited tests. That's the big thing everyone wants to hear about. Want to hear more about that in probably next quarter earnings. That's the big holy grail for the company, unlocking potentially trillions in value, as some analysts have said, like Dan Ives, for instance.
Why are Tesla investors so forgiving of Elon Musk?
I mean, I would have to say it has to do with the fact that he's a visionary. They buy into his sort of reason of being. He took a private company and went into space. No other company's done that privately. Look at EVs. Before we had EVs that were bulbous and ugly and slow, he made them cool and fast and exciting. So I think that's all part of his, this sort of the vision of who he is and why he's so compelling as a character. And he is a little awkward, but he's also kind of charismatic too in his own way. So I think that's why we're seeing the stock, the retail investors still staying with the company. And there are some big professional money investors that are actually in the company too, and they haven't left yet. So.
And it's hard to think of another company, Praz, that is so connected to that CEO. I mean, Musk is Tesla. Tesla is Musk.
Yeah, we've talked about this before, and I think there is a deep bench at that company. It is a large company. There's a lot of people there that still work that are very talented, but I think Musk still drives the overall, what is Tesla? It's him, and that's what I think a lot of people want to see, is him back at the wheel, essentially, and back in Austin.
Praz, thank you, buddy. Appreciate it. Well, Tesla stock seeing another wild week of headlines for the car maker when Elon Musk renewed focus on his enterprises. We're looking under the hood of the next phase for Tesla. Doug Clinton, Intelligent Alpha founder and CEO, joins us now to discuss. Doug, it is always good to see you, my friend, on the show. Let's start, Doug, right there. Trump, Musk, this joint event today. As we were just talking about, Musk now returning full-time to work. How important is that, in your opinion, for Tesla shareholders, Doug? How excited should they be about that return?
They should be absolutely excited, Josh. And I'll just say for the record, I've been punched by my 5-year-old. They are absolutely more ferocious than they look. Whether that's true or not, who knows with Elon. But investors should be very excited that he's coming back and now has this new laser focus. And the way that we've sort of thought about this is that you look at famous people, very successful people throughout history, there tends to be this arc that they go on. You go from sort of obscurity to hero, ultimately to villain. And then you kind of figure out, can you become hero again? I actually think Elon's about to embark on this redemption arc, maybe the likes of which we've never seen. In some ways, I think about Steve Jobs, who went from hero, who created Apple, kind of lost his way a little bit. We talk about being lost in the woods. He started Next, made Pixar, an incredible company, then came back to Apple with an incredible redemption story. Elon's story is different, but I actually think the pattern is maybe a little bit similar, and I think it all starts with Tesla.
Doug, on that redemption arc, though, let me get your take on this. And our friend and colleague Praz did bring this up. This report today, Doug, in the New York Times, about Musk, saying his drug use was more intense than previously known. His drug consumption went well beyond occasional use. I'm just curious, Doug, as an investor, you read a headline like that, you read a story like that, and what you make of it. Does that impact your willingness, your interest to commit capital in Tesla? Does it not have any effect? Walk me through your thinking.
I think it's something that you have to always note. And for the record, I mean, these sorts of allegations and suspicions have followed Elon for a long time. This is not the first report about him potentially using illegal substances. And so, from our perspective, the way we have always thought about it is that even amongst people who are wired differently, Elon is wired even more differently. And as long as the drug use is not to an extent where, it's impairing his function, I don't think it is. I think you have to kind of at least put that in your fact box and say this is something that we need to monitor. But I don't think it is a totally excluding event for him. And again, I'd point to Steve Jobs, right? I mean, there's been a lot of talk in the past about him. He used LSD. He admitted it. I don't think he was a regular drug user. But I think a lot of these very visionary people do tend to maybe dabble in some of these substances.
Doug, I want to broaden the conversation out a little bit here and go a little bit more broader tech and maybe focus on semis and some of those other Mag 7 like NVIDIA. I'm curious what you make of the news coming out today from China, right? Of course, we have President Trump essentially threatening to maybe escalate those tariffs again, maybe that pause that they're working on and that deal isn't going so well. How are you viewing where the U.S. sits with China and how much it actually matters to where you're allocating money in the tech space?
It's absolutely important. I think that over the last month and a half, one of the key lessons investors have sort of learned is that everything is a negotiation when it comes out from this administration. At least that should be the initial assumption. And so when you hear this news out of China, things being frustrating, maybe more tariffs coming or other actions, I think you first have to say, okay, is this sort of a negotiation to try to get things back on track, to get into a more favorable place? And most likely, I think that it probably is. So, you kind of set it aside at this point and say, if you think the world looks, maybe 10% plus on tariffs from where we were at the beginning of the year, in the next 3 to 6 months, if that's the major change, and you probably don't change your investment strategy that much. I think one thing that's really important, you mentioned big tech, and I think for NVIDIA specifically, is, deals are the love language of this administration. And I think a question for NVIDIA specifically is, can this administration find a deal with China that will also allow them to open up the country again to NVIDIA selling their products there? That'd be good for the stock. I ultimately do think that will happen, and it could be a catalyst.
I like that. A negotiation could be a love language too, I guess, depending if the deal comes or not. A quick question on the broader trade, and also just wanted to go back to Tesla for a minute as well. Do you believe that the rebound we're seeing, the buying the dip rebound pattern retail investors have been engaging in, is a reflection that the taco trade actually exists? And then what are you looking forward to, or what are you looking for in general out of the robotaxi launch in Austin?
I would say for the robo-taxi launch, we want to see sort of a reiteration of the timeline that Elon put in place. So, we're expecting 10 to maybe a dozen vehicles initially, very small initial test, and then thousands of vehicles hopefully by September. That's sort of the stated timeline. I think to the extent that we get a reiteration of that, that's good for the stock because often timelines obviously get pushed with some of these launches. So that'd be the big thing I'm looking for. And then secondarily, I think back to that redemption arc, right? What is Elon's mindset? How does he kind of talk about, maybe this new era for him, refocused on his companies? And I think that robotaxi is probably the number one thing on his agenda right now, if you look across all of his companies. In terms of the stock, I think Elon is one of those characters where we've always said, I think it's silly to ever bet against him. I don't think that means you should blindly sort of bet on him all the time. I think you want to pick and choose your timing. We've seen the stock go up 25% here in the last month. So I think there is some optimism coming back into the stock. It's hard to see the fundamentals really giving the stock another boost. So for me personally, we don't own the stock in Intelligent Alpha at the moment. I'd be a little bit more cautious and probably look for a dip to buy. But again, this could be a meme stock. If we go back to the Elon redemption arc, I mean, this could just purely be almost like a meme coin, just betting on Elon.
Doug, as we mentioned, you are the founder and CEO of Intelligent Alpha. And what you do over there, so that viewers understand, is very interesting. What you're doing is you're using large language models to pick stocks. So your models right now, Doug, they're telling you to own what? NVIDIA is our top stock holding right now. And ironically, gold is actually our top holding, period. And so what our portfolio looks like right now at Intelligent Alpha with our models is we almost have this barbell approach of AI as sort of an offensive, aggressive bet. Our models believe that the AI trade will come back this year. And on the other side of the barbell, we sort of have some defensive positions in gold, some European equities that I think were undervalued, obviously, earlier this year. And so far, that has treated our portfolio quite well. We've done well against the S&P 500 with that sort of barbell approach. Doug, we are always lucky to have you on the show. Thanks for joining us today. Appreciate it.
Thanks, Josh.
We're just getting started here on Market Domination. Coming up, we're counting down to the closing bell on Wall Street, breaking down the market-moving data today next. Plus, JP Morgan CEO Jamie Dimon, he's speaking out on the bond market, why he thinks cracks are emerging. And Palantir, top trending ticker on Yahoo Finance, the stock trading near record highs here. We've got a look ahead at today's action later this hour. Well, the Fed's preferred inflation gauge, PCE, continued to cool in April. Further proof that President Trump's tariff policies aren't yet having an inflationary impact on the hard data. Investors now expect the FOMC to hold rates steady through the summer, with the probability of at least one cut in September now over 70%. That's according to the CME FedWatch tool. Joining us now is Chris Fasciano, Commonwealth Financial Network Chief Market Strategist, and Leo Feller, Numerator Chief Economist. Gentlemen, both of you, welcome to the show. Chris, I'll start with you and walk us through today's action, Chris, in the markets. Trade and tariffs, front and center again. We had President Trump this morning, Chris. He's on social media. He's going after China. He's talking tough. We had a Bloomberg report that the administration perhaps planned to expand these restrictions on China's tech sector. You as a strategist, Chris, you've got to navigate these headlines, navigate these reports. Walk me through how you think through these dynamics as a strategist.
Yeah. Today's a really interesting day to me because one of the things I've been focused on after the strong rally we saw post the pause was whether investors were going to be willing to look through negative headlines on the belief that things will continue to get better going forward. And today's action kind of tells me that for the time being, they are. They do believe that tariffs are being used as a negotiating tool and that over the course of the rest of the year, they will be reduced through deals, if not eliminated. And investors are, rightfully excited about that because it's taken the tail risk of the most negative scenario on the economy and corporate earnings off the table. From my perspective, though, there is still a fair amount of uncertainty on tariffs, on the budget bill, and on economic data. So I continue to advise our clients that diversification is the best way to navigate that. It's worked so far this year, and I think it'll continue to work for the rest of the year.
Leo, it's Josh here, and I want to bring you in and talk economy for a second. I'd normally be asking you about this morning's PCE print, right, and sort of what it means for the Fed, and it was a great print. Is the Fed going to cut soon? It feels like that conversation just isn't quite happening after some of these prints because we keep waiting for the shoe to drop, right? Okay, when are the tariffs going to impact this data? When's the data going to start to shift? How are you seeing that? Do you think the data is going to really meaningfully shift and we're going to get a pickup in inflation? And I guess when are you sort of projecting that might start to happen and we can start really using this data to understand what's going on?
Yep. Thank you so much for having me on. So don't forget, this PCE report that came out today, it's backward looking. It's looking at what happened in April, right? And so in April, that's still way too early for any of the tariffs to have had any kind of meaningful impact on consumer price inflation. What we expect is that as firms deplete the inventories that they built up, and we also saw that firms built up a lot of inventory in January, February, and March. It's really going to be as those inventories are depleted, as firms are starting to bring in additional goods coming in from abroad, that's when the tariffs are likely to start having an impact. And so we're really thinking about perhaps later in June, July, August, and on things that are going to be produced abroad. You have to think about things that are going to be like back to school shopping, backpacks, apparel, computers. Those are the items that would really start showing some kind of inflationary impact. And as you said, I think the Fed is right to look through these current numbers because they're talking about what could have been the case, had it not been for these trade wars, had it not been for some of the policy uncertainty. And they're really waiting to see whether or not there will be this uptick in inflation going forward so that they don't make the same mistake again of thinking that there might be a temporary inflation shock, transitory inflation that turns out to be much more persistent as we had in 21 and 2022.
Leo, I want to stay with you for a moment here. Among all the chaos that we're seeing and the chaotic data, what continues to be the most reliable and most trustworthy leading indicator for you?
I'm looking at a few things. One is what is happening to initial claims for unemployment, what is happening to continuing claims for unemployment. We saw yesterday that there has been an uptick in continuing claims. That means it's harder for people who are unemployed to find jobs, and so they're staying unemployed longer. That starts suggesting that firms are a little bit reluctant to hire, and that unemployment might start ticking up in the next several months. So a leading indicator of unemployment ticking up in the next several months. We are also looking at retail sales, right? How resilient are consumers? How much are consumers able to continue to go out and shop? And that's been holding up pretty well, but some of this really is just higher income consumers being able to front load tariffs by going out and spending on bigger ticket items right now so that they don't face higher costs going forward. And that suggests that this increase in these past couple of months is going to then lead to a trough later on because consumers have already gone out and bought TVs and apparel and furniture and appliances to try to get ahead of tariffs. And so both of those tend to suggest that things might actually start slowing down both on the labor market front and in consumers already being able to satisfy some of the consumption that they made early on. And that means, less consumer resiliency going forward.
Chris, back to you. You emphasized, Chris, that we're dealing with this uncertain macro backdrop, that it's prudent for investors to stay diversified. What does that mean, though, Chris, when you talk about diversified? How do you want to be positioned in the market?
Yeah, I think given the macro backdrop that Leo just talked about, I think he's absolutely right. The concern is that the soft economic data bleeds into the hard economic data, and we see a slowdown followed by further cuts in earnings, that you don't want to be making bets in one direction. So I'm sympathetic to the barbell strategy that was mentioned previously, but I would broaden that out. So I think you still want to have exposure to the winners of the last couple of years, large cap growth, tech, the Mag 7. But we have seen a broader market this year. Financials have acted well, industrials have acted well, and their earnings growth going forward seems to be fairly robust. And the really interesting thing to me this year, after being left dead for the last 10 plus years, is international is helping portfolio. So I think you need to have international exposure. So I would say, growth, a little value, some of those sectors that are working, and international exposure to offset the risks we're seeing in the United States.
Chris, Leo, thank you, gentlemen, both today for your time. Enjoy the weekend.
Thank you so much.
You too.
Coming up, Google's landmark antitrust trial wrapping up, how AI could play a role in the judge's decision there. You're watching Market Domination. Now time for some of today's trending tickers. We're looking at the 10-year Treasury. JP Morgan Chase CEO Jamie Dimon saying we're going to see a crack in the bond market. Dimon making the comments at an economic forum Friday, Josh. So Dimon saying, issuing this warning, there's going to be a crack in the bond market. You're going to panic, he says. He says he's not going to panic, but you're going to panic.
I might.
Yeah, you might. Maybe everybody will. It is Jamie Dimon, and so obviously when he speaks, people do pay attention, and he's right to say that you stay focused on the bond market, which was spooking folks, and we can debate the reasons why. Maybe it was debts and deficits, or was it recession fears and winding? Was it the selling in Japanese government debt? But it was spooking folks.
There's something about Jamie Dimon and always hitting exactly where kind of the market zeitgeist is, right? If we're talking about the Fed and the Fed should cut, seems to be the narrative that's out there. It feels like he starts talking about rates. If it's recession, it's that. Bond market's definitely been the conversation, right? And I think to Dimon's point, higher yields have weighed on stocks, right? That's been the clear trade over the last month in the sense that a lot of the broader market has struggled as rates are going higher, and it definitely feels like the biggest fear, or one of the biggest fears in the market right now. Citi's Stuart Kaiser laid out kind of 3 key risks to the bond or to the stock market, and he said simply that premium, that bond market premium continuing to move higher is one of the key risks he's concerned about right now.
And yet also hope, though, it does feel like things have perhaps right now calmed down a bit. I mean, I'm looking at the 10-year benchmark. We are back to 4.4.
Well, what I find interesting, he also said in this conversation that this may be the wake-up call that we need. I mean, I think with what we saw last 2 weeks, we got the wake-up call already. So I'm not really sure what this really adds. I mean, of course, he's always going to make news with what he says, but you know, I think he's already, to your point, talking about the zeitgeist, and we've been talking about it for a while. So, you know, to me, it's always nice to have a Jamie headline here and there, but I'm just really not sure what new things we're learning from his insights today.
I mean, he's right, Bob. I mean, debts and deficits are a big challenge, and bond market's going to have to navigate that. We are checking in on Palantir, and by the way, those shares tacking on a nice 5% in today's trade. That's after the New York Times reported President Trump has expanded the software company's work across the federal government, tapping the company's technology, which can easily organize, we know, and analyze data pulled from different agencies. So this was the Times report, how the Trump administration has expanded Palantir's work, Josh, with the government. They say the company has received more than $113 million in federal government spending since Trump took office. And that doesn't include, by the way, they see this nearly $800 million contract that the DOD awarded Alex Karp's company last week. This has not been a stock, by the way, you want to bet against. It's been rough.
No, short sellers have lost over $2 billion betting on this stock since April 8th. That's from S3 Partners, Josh. But you just zoom out on the stock like we're doing right now, right? You look over 6 months, things up 91%. Like, stock is now trading at basically an all-time high, right?
Around 470% over the past 12 months.
Yeah, it's a crazy, crazy chart. And I think when we were talking about this before the show, I was looking, stock was only up 1%, and I was like, okay, maybe we finally just maxed out on potential catalysts here, because it is a good contract. And the stock wasn't moving that much. Now, interesting as we get the broader market rally that we're starting to see into the close, Palantir is one of the key movers. Palantir feels like it's been a little bit of a leader for the market. Palantir kind of moves a little bit higher than the market's moving, but it's definitely one of those hype trades, right?
What do you make of it?
When Palantir, NVIDIA, these are companies you don't bet against now. I think what's most fascinating to me is that there were some concerns that defense stocks were going to get hit as the DOGE operation was well underway, and the fact that Palantir has done better than most expected, but clearly still winning more contracts, and that Trump is very much leaning into Karp's business is obviously another reason that you will not now bet against Palantir.
And by the way, what else happened this week? Fannie Mae told us they're launching this AI-powered crime detection unit. Who do they partner with? Palantir. All right, Google and the Justice Department's landmark antitrust trial coming to a close. Attorneys making their closing arguments as the search giant fights to keep its Chrome business 9 months after a federal judge ruled that Google has an illegal monopoly in the search engine market. Yahoo Finance's Dan Howley joins us now. Dan, the judge overseeing this case, questioning the future of search engines amid the rise of AI.
Yeah, Josh, Judge Mehta, he's the same judge that sided with the DOJ originally, saying that Google maintains an illegal monopoly in the search industry. He's also now going to decide what happens to Google, whether or not they get to hold on to their Chrome browser, whether or not they have to share some of their data with competitors, and whether or not they have to stop doing exclusive agreements with the likes of Apple and Samsung. So let's just kind of break that down. The first part, Chrome, would be a dramatic change for Google. The base search on Chrome is obviously Google search, and Chrome is the most used browser in the world. So if Google loses that and the Google is no longer the base search engine for Chrome, or some other company snaps it up, that could give rivals a big advantage. On the other side, when it comes to those exclusive agreements with the likes of Apple and Samsung, it would hurt both Google and Apple and Samsung to a degree. Basically, Google gets placement as the default search engine in Apple Safari and other services. In return, Apple gets $20 billion a year that goes into its services revenue, which is a nice chunk of change when it comes to the annual services revenue. So that would also be an issue overall. And then Google says that sharing its data would just give more advantage to its competitors. But this all comes, as you kind of alluded to, is there's this backdrop of AI search that's kind of exploding now with the start of ChatGPT in 2023, moving on throughout. And we have ChatGPT has its own search engine now. Perplexity is a search engine. We have Anthropic and Claude that can do real-time search as well. Google isn't sitting on the sidelines, though. They have their AI overviews as well as their new AI mode, which is more or less a version of ChatGPT or a rival to ChatGPT. But there's also concerns that Google may be losing some of its market share. There was a portion of this trial where Apple SVP Eddie Q came in and said, look, we saw the first decline in search queries in Safari in April. And that was a first for them. Obviously, the fact that Google is the original search or the default search engine for Safari means that they saw a decline in Google search as well. But Google kind of shot back and said, look, we're seeing increases in Google search overall still, including on iOS devices. So it's going to be interesting to see how this all turns out.
All right, we'll be watching. Dan, thank you. Coming up on Market Domination, Regeneron shares sliding after some trial results were released today. But first, here's a look at Yahoo Finance executive editor Brian Sozzi's interview with Gap CEO Richard Dixon on the company's earnings earlier today on Catalyst.
The strategy is working. I remain incredibly optimistic, realistic about the opportunities ahead. And as we navigate a highly dynamic environment, we're really quite pleased with the progress.
Richard, I've talked to you every quarter, I think, since you took over as CEO. And every quarter, I would say Gap has been like a runner, like getting increasingly faster. The turnaround is gaining steam, and then it's smack. Now we're in a trade war. Has this trade war stalled the progress you've been able to make within your brands?
No. I mean, look, there's like any business, and we've talked about this before, we're constantly navigating complexity. There's all sorts of complexities in running a business, and in this case, tariffs is a focus. But it's our responsibility to do so without ever compromising the long-term integrity of our strategy. And as we know, the most important part of this is the consumer. So we're very concentrated on ensuring that the consumer proposition and the value orientation of our brand resonates, and it is resonating. Again, 9 consistent quarters of market share gains. We're breaking through in a competitive landscape. We're reinvigorating our brands, and the statistics are showing that our progress is really there.
Richard, I was talking to, this week, the CEO of HP. Of course, they make printers and PCs, and he gave me an interesting stat. He said, Brian, we're going to be out of China very soon, completely out. It shocked the hell out of me. I mean, are you there yet?
Well, China, as an example, in our last conversation, I think I shared with you that China was about less than 10% of our sourcing, which we've been diversifying our sourcing footprint for several years. I'm really pleased with the team's progress, quite frankly, in continuing that diversification. We shared yesterday that we now expect China to be less than 3% by the end of this year. So a real diversification in place. And by the end of 2026, we're planning for no country to account for more than 25%. Also, one of the important notes is we're investing in the U.S. as we plan to double our vendor sourcing of American-grown cotton. in 2026 as part of our diversification strategy.
Are you able to, let's call them capsule collections, will there ever be a time when Gap is making clothes in the U.S.?
We do have some manufacturing in the U.S. We do denim, we do some T-shirts, we do knits. We do also run all of our design, development, all of our retail operations. We're an iconic portfolio of American brands. We have about 90% of our sales in the quarter in the U.S. We have an American workforce of over 65,000 in the U.S. It's an incredibly important market for us. We've got great vendor sourcing partners domestically, and we already use a significant amount of U.S. cotton. And as I said, we plan to double our sourcing of U.S. cotton in 2026. We're increasing our design investment. We're working with very exciting design houses in the U.S. So we continue to constantly evaluate opportunities and also concentrate on where we can invest domestically.
Just given the globalization push for retail the past 10, 20 years, Richard, has that ship just sailed in terms of making clothing at scale in this country?
Look, I think it's a big question with answers that are well known in our category. To the extent that we have a very diversified sourcing footprint, it is important. You know, we are the #1 e-commerce apparel business in the U.S. We are the #1 specialty apparel chain in the U.S. We've got a very large business across all categories of apparel. So it is important that we have agility in our manufacturing and sourcing footprint, and we're really pleased with the progress that we've made, and it does create a resiliency to the company that we're enjoying right now.
If there are no trade deals, if there isn't a trade deal with China this year, Richard, does that bring the lower end of your guidance into play for the year?
Look, I think our outlook, first off, as we shared yesterday, first and foremost is transparent. We were very purposeful in separating the outlook from the estimated tariff impact. And we believe that the outlook that we provided gives a real perspective of the underlying health of the business, which is working, as evidenced by the exceeding expectations in the quarter, and both Gap and Old Navy being obviously a strong performer in the quarter, as well as consistent. So the estimated impact of the tariffs could still change. You know, a couple days ago, we had new news in relation to the tariff. So the first half of 2025 should be largely unimpacted by current tariffs. There's nothing in Q1, minimal impact to our Q2 outlook, and the estimated tariff impact that we provided today and that we've shared with our investors is it's primarily weighted to the second half. And as we also know, there's going to be more information to come. It's a constantly moving target. There's another milestone day in terms of information on July 9th. So what we wanted to make sure is that we stay true to the long-term integrity of our strategy, that we monitor our business associated with tariffs. We're very realistic about it. As we've shared, we've mitigated over half of the challenge on tariffs. We're determined to drive, again, the other half as well, and continue to do what we do with, you know, executional excellence.
A new phase is cooking up on Wall Street. It's called the taco trade, and it's leaving a bad taste in the mouth of President Trump. Joining us for the weekly Yahoo Finance Investor Playbook is senior reporter Allie Canal. Allie.
Well, it's been another busy week of policy pivots, headline whiplash, and economic data that's left investors more confused than confident. But through it all, one phrase has gained prominence this week: the taco trade, short for Trump always chickens out. That phrase sums up a growing view that while the president talks tough on tariffs, he rarely follows through. And it's that assumption that's driven the market recovery we've seen over the past month. Still, it's not foolproof. We saw sentiment take a hit today after Trump fired off a post on Truth Social accusing China of, quote, violating its trade deal. Just hours later, Bloomberg reported the Trump administration is planning to tighten tech sanctions targeting Chinese subsidiaries that had been skirting existing curbs. The news initially sent stocks sharply lower before we saw a bit of a rebound heading into the close. And adding another twist to the saga, a federal trade court in Manhattan struck down a swath of Trump tariffs, citing legal flaws in how they were imposed. And although a federal appeals court temporarily paused that ruling, it's just adding more fuel to the fire when it comes to a lot of this market uncertainty. Looking ahead, some say stocks are banking too heavily on Trump backing down again. Here's what Wall Street experts told Yahoo Finance this week.
We told Donald Trump that we have this taco trade. And so I worry a little bit that actually makes him bear down a little bit more and decide to be more, gripping on some of these tariff trades. And so I have a little bit of a concern that creates actually more uncertainty.
So I don't think this is the last word on tariffs, but I agree. This is a roller coaster ride, not good for long-term planning and not good for corporate investment.
Based on the past, we're going to get a lot of he loves me not, the taco trade, the tofu trade. We're going to get a lot of that talk back and forth, but what investors really need to be focused on is economic data, especially the jobs week that's coming up next week, and what the Fed is doing in response.
So bottom line here, the taco trade may still potentially have some mileage, but as politics, policy, and legal realities collide, that bet could be looking a lot riskier. And guys, I looked up what exactly the tofu trade is that Callie Cox referenced. Apparently, it's been circulating on X. It's that Trump always likes to intervene when markets are at highs. I don't really know how the acronym plays out fully there, but it just goes to show how investors are really trying to understand this administration amid all of these shifting trade policies.
Yeah, it is hard to follow. Acronyms can help, though. Allie, thank you. Appreciate it. So the talk on Wall Street this week was all about the taco trade, but Yahoo Finance senior columnist Rick Newman has his own take that the premise of the taco trade isn't true. And Rick joins me now. How so, Rick?
I'm sorry, guys. So if you said Trump sometimes chickens out, you'd be right. But the Tisco trade, it just did. I mean, it doesn't work.
It doesn't
right?
roll off the tongue.
I mean, look, I love the memes. I love the Trump in the chicken suit with the feathers, the tacos on his gold jacket and stuff. But I mean,
he didn't look happy to be asked that question.
He hated the question.
He did not enjoy that question,
which made it even more fun, to be honest. Yeah. But look, I mean, I've been following every step of the way here. Trump is, at the end of the day, we are going to end up with tariffs on imports, taxes on imports that are going to be something like 6 times, 8 times, or 10 times higher than when Trump took office. So where we stand right now, worth reminding people. Trump took office with the average tariff on imports at 2.5%. It's now around 18%. That is with the emergency tariffs in place. We now know that there's some question legally about whether those will stand. The Supreme Court is going to decide that. But if the courts do end up shooting down all those emergency tariffs, Trump's got at least 4 other ways that he can impose these tariffs. He did some of them in 2018 and 2019, so we know they're likely to be more durable legally. And Trump is going to do it. I mean, people who know Trump, I mean, if you haven't been paying attention, Trump is a true believer in tariffs, despite all the evidence. This is going to make the economy worse off on it. He is going to do it. He's going to find a way to do it. So Trump sometimes chickens out, but he does not always chicken out.
What do you make of the market response to all this? In the sense, we're about to wrap up what was a solid month for stocks, Rick, and a big rebound off the April low. Even the bond market, we were talking earlier, it's taken a deep breath. It's calmed a bit. The benchmark 10-year back to 4.4. What do you make of that?
Trump lowered the China tariffs from 145% to 30%. That's the answer, right there.
Chicken out, Rick.
He didn't, because if he didn't completely chicken out, if he did, he would have taken it from 145% back to no additional tariffs. But so that's where we are. We went from started with no. I mean, there were already tariffs on Chinese imports, but the new ones are 30% right now. Trump went from 145% to 30%. So that represents the whole strategy, which is he starts out super high and ends up somewhere that's not as bad, but still somewhat uncomfortable.
Rick, thank you. Always
Bye,
appreciate
guys.
it. Thanks. While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.